The stock market should have crashed by now.
Every major warning sign is flashing red.
Consumer debt is exploding.
The economy is starting to bend. Yet somehow, the market keeps climbing.
Today, I'm going to break down the real reasons behind this, the reasons you won't hear from banks or on TV. Because once you understand what's secretly holding this market up, you'll see why the delay is actually the most dangerous part.
My name is Seth. I've worked in fintech and banking for years, and even with an MBA and finance background, I used to look at the market and think, how is this even possible?
Inflation was out of control.
Layoffs were rising.
The recession alarms were ringing for years. And the market kept pushing higher.
Then I realized something most people never notice.
Markets don't crash when things look bad. They crash when the support beams holding everything together finally snap.
And when you understand those beams, everything happening right now suddenly makes sense.
1. The indicators say the market should already be crashing. Let's start with the obvious. By every historical measure, the market is massively overvalued. Warren Buffett uses a ratio that compares the total market value of all public companies to the U.S. GDP. Right now, that ratio is sitting around 220%. For context, before the dot-com crash in 1999, the ratio was only 115%, and the market still fell over 60%. The same thing is happening with PE ratios. Historically, the S&P 500 sits around a PE of 15 or 16. Today, it's hovering between 25 and 28. But the real issue isn't the overall number, it's the companies propping up the index. NVIDIA, PE around 50. Amazon, 35. Microsoft. Tesla, over 250. Investors are paying $30, $40, even $50 for $1 of earnings. That's not normal. And before the dot-com crash, PEs were almost the same as today. Every signal says the market is stretched. Yet it refuses to fall. Which brings us to the hidden forces. Two forces quietly holding the market up. Even with inflation, high debt, slow hiring, and weak earnings, the market still hasn't collapsed. Why? Because two big forces are propping everything up. Force number 1, hidden government stimulus. Most people think stimulus ended years ago. It didn't. It just changed shape. The government collects about $5 trillion in taxes, but spends around $7 trillion. That extra $2 trillion flows into companies, then workers, then consumer spending. Spending, profits, stock prices. This keeps everything inflated longer than it should be. But with nearly $40 trillion in national debt, this can't last forever. Force number 2, dollar devaluation plus inflation. A weaker dollar makes exports cheaper. That's intentional. But other countries are also moving away from the dollar. Demand falls, dollar value drops. When the dollar weakens, prices rise. When prices rise, corporate earnings rise, not because companies grew, but because inflation makes numbers look bigger. It's fake growth. And Wall Street loves that illusion. Here's the secret nobody tells you. Inflation actually benefits investors who borrow money to buy assets. Their debt becomes cheaper, while their assets become more valuable. So big investors keep borrowing, keep buying, and keep pushing the market higher, for now. The crash isn't canceled, it's delayed. The market hasn't crashed because temporary forces are holding it up. But those forces don't last forever. When they fade, the market won't ease down slowly. It will snap back to reality. The longer the delay, the sharper the correction. This isn't about fear. It's about understanding what's happening so you can stay calm, stay prepared, and make smarter decisions when others panic. If this breakdown helped you make sense of what's going on, hit subscribe and like. We publish simple, practical content every week to help you build and protect your wealth.